So Mike, I was hoping that maybe we can go into a little more of the, the concerns that you hear when you're speaking with clients, maybe some of the challenges clients are facing in today's current market. I mean, I'm sure interest rates, as we're recording this, March of 2023, interest rates are probably a hot topic, and maybe talk about some case studies of folks that you're working with and, some of the challenges you're facing, also probably some of the successes you're having.
I guess if I was introducing myself, I would say that I'm the CEO and managing director, also kind of the president of the NNN Investment Company. The real estate world, anytime you see NNN, it's the short version of triple net, right? And again, we kind of talked about what that means in the last video, but that's right. Yeah. So our website is NNNINVCO.com, short for Triple Net Investment Company.
Got it. It's a great website. Looks like there's a lot of information on there. You've got some great photos of some examples of some net lease properties on there. Just give us a quick 30,000 foot overview of what we're talking about when we're talking about net lease commercial real estate, Mike.
Sure. So a net lease property is generally categorized as a single tenant asset or a single tenant building that has a lease in place whereby the tenant pays all of, or in some cases, most of the expenses associated with the building. So the triple net lease, as the term is thrown around oftentimes, really means that your tenant will pay your property taxes, your insurance, and for all of the maintenance and upkeep of the property, so that the rent the landlord receives is net to you. So if you got $135,000 rent, that's what actually flows into your bank account. You don't have to pay for any of those other ancillaries.
And when you think about the typical client that comes in and is interested in a net lease property, what are they generally looking for? Why would I want to buy a net lease property?
Well, there's a lot of things that you can get with a net lease property. Say you're coming from like an apartment complex, for instance. So what I really try to focus on is somebody's coming to me. Generally, they've had other real estate. They're in an exchange. So we want to find something that is going to hold its value. So capital preservation is paramount, right? We want to go buy something that's not going to see like a big drop in value over time. We also want to make sure that there's going to be increases in rent over time, cash flow increase. And then we want to make sure there's stability, right? Safety in who that particular tenant is. And a lot of times in these net lease assets, the tenant is a corporate company like McDonald's or Panera Bread, or it could be Walgreens, right? So they're companies that you can go do some research on the web on. A lot of times their financials are public, very safe, sound companies to deal with. One other benefit of the triple net property, right, is that it can also be a succession planning tool, right? So I'm getting older. I want to set my wife up with an annuity, basically, that she's going to have some income for the rest of her lifetime. And then our children will have an asset that will provide them cash flow. So there are multiple things to consider. And that vehicle is used a lot. And we see that a lot. But what we do find a lot, to go back to your question here about somebody who's thinking about investing in a triple net property, one of the things that we often hear about is, well, before I even sell my apartment complex, I need to find something because this idea that going and looking for a property through an exchange, right? It's difficult and it's cumbersome. And I agree, you want to have a professional in your corner who knows how to navigate that. That first and foremost is what you want to do. It's going to reduce your risk down to, a very minimal level. But I don't think that most people think this through, right? In order to go buy a property, you have to kind of be able to put a down payment on it. You have to have this process of how you're going to buy it. Are you going to pay cash? If you're going to pay cash, where are those funds coming from? Are you going to use financing? So a seller of a property wants to know that if somebody's interested in their property, they're ready and willing, they have the funds to consummate a transaction. And the saying in real estate is true, right? Time kills all deals. So really, you have to make the decision on the front end that you're going to sell the apartments or the relinquished property, sometimes referred to as a down leg. And then once that happens, there are all these safeguards we can put into play in order to protect you. So I wouldn't just go sell something on a whim and look for something. You have to strategize beforehand, but we can do that. We can put some plans in place that protect somebody.
Went on Crexy before we got on this call, and for those who don't know, Crexy is a real estate marketing site that has a number of different types of properties, has a number of different triple net properties for sale, and it looks like there's about 1,800 on there right now on the criteria that I put. So I guess my question is, clearly these aren't going to be on there if someone's in a 90-day escrow. You know, some of these may appear and then they may go under contract and disappear. So when you're meeting with a client and when you're talking about that concern of should I sell my apartments before I look, are you consulting with the client really to get a sense for what type of property they're looking for? And then once that timing gets going, we're under contract, we're in escrow, then start looking at specific deals? Is that kind of how you handle your sales process?
Yeah, I mean, that's a great question. So absolutely, one of our very first steps is let's meet the client and let's make sure we have a meeting of the minds. It's interesting because all of the meetings generally are pretty similar, right? I mean, most of the clients, these guys, most of my clients aren't young men and women. So, they've kind of been around the block. They're really looking for that stability. And that comes from a corporate long-term leased asset in a good market, right? And I think I have been successful in my 17-year career because I have really focused on those high profile tenants who are in great markets, long-term leases. We've run into very little problems. And the ones that we did, we kind of knew they were coming down the pipe because of certain characteristics of the deal. So generally what I try to do is, and for instance, you and I would meet with the client, say, hey, I have a client, Mike, he's thinking about selling his apartment complex. We would go together to dispel some of these myths, and some of the discussions that we would have surround the amount of money we have to invest, whether or not they plan to use any type of financing. And if so, have they met with anybody? Can we help facilitate some introductions from that angle? Where they're interested in investing. And I usually say, look, there's a lot of people that are interested in tax-free states, but in general, we try to stay in the southern US and along kind of the borders, what we call the growth states. So we will occasionally buy in the Midwest, depending on location, tenant, deal term, total deal metrics. And then we discuss kind of strategy, right? And some of those strategies that you and I have kind of collaborated on in the past are, my job starts the day that you take the apartments, if we're using an apartment here as the example, out to market, right? We're going to start narrowing down on, hey, how does this feel? Does this feel like it fits with what you want? You have a gut feeling. Somebody might say, Mike, I don't like this restaurant. I don't want to eat there. I don't like their company values. Okay, that's fair. But we can generally go search around different parameters and look for similar style assets. But once we have all of that figured out, I generally start the process, and I mean, we really get going. I want to be writing offers. When you have offers on the table, you select a buyer, and then that buyer goes non-refundable on their due diligence, because that signals to me you've got somebody who's interested in buying that apartment complex, so much so that they've removed their contingencies, right? And they're willing to walk away from $50, $75, $100,000. Now we have real interest. I can translate that to a developer, to another broker, to a seller, and say, they've got money in escrow already. They've already waived their contingencies. Our clock has officially started and we're looking for deals. So that's the process that I generally stick to. And there's a few other nuances that we can explore or talk about on the podcast here about how we set up clients for success as well.
Yeah, that's a really good point. I mean, again, it's first quarter is almost over in 2023. Interest rates have doubled. Are you still seeing that there is a lot of cash out there looking for a home in the net lease marketplace? And is it still pretty competitive out there from a standpoint of we've got to show the confidence of the to the agent and to the seller that we're going to be able to get this done, especially having a full commitment release on our down leg property. Is that what you're finding?
Yeah, I mean, I think actually it's interesting because I think it's at an all-time high of when we really need to be buttoned up on the buy side. So if I'm representing somebody, I want to really be able to communicate to that broker or perhaps to that seller that we're going to be able to perform. Because in this market, if you think about it, right, let's say you're trying to sell your commercial building. You engage a buyer, that buyer takes you through a 30-day due diligence and then decides not to purchase the property. Well, as we have seen just within a week, right, interest rates can really shift pretty dramatically. And so that could be detrimental to a seller, or it could really leave a bunch of money on the table for him. So that's why, over the lifetime of my working in the real estate world, I've been able to build relationships. And so when I take deals to these guys and say, hey, we have a buyer who's ready and willing and he's interested, they know that we're going to perform. And so they're willing to give us deals because they know that, hey, look, we close deals with them. We say what we say and do what we say we're going to do. But yeah, that's really important in today's world. So having deals back out or slide off isn't great. And to your point, financing right now is kind of tumultuous. So, that's another lever that we kind of have to think about when we're going into this transaction.
Yeah, it seems like you'd want to get ahead of all of that, the financing piece, the type of property. As you and I both know, one of the number one concerns that a seller has who's been comfortably sitting in their 10-unit apartment building for the last 30 years is that 45-day time frame that the IRS gives them to identify up to 3 properties in a 1031 exchange. That's the big concern. You mentioned that many of your clients aren't young men. What is the typical time frame that you find it takes to identify that up-leg property, that next purchase, and then get to the point where you're going under contract and moving into close?
I mean, I'll be honest, it really varies, right? It's different for every transaction, but the way that we kind of hedge some of that risk is, like I said, once the purchaser of the apartment complex, right, so on the relinquished property side, goes non-refundable, we start writing offers. And I call that the free period, right? Anything from there until the property closes, really up until the identification period, there's this, at times there can be a myth or this thought that, well, we can only write so many offers. Well, that's not true. You can write as many offers as you want, but at the end of your 45-day period, you have to identify 3 properties. And then at the end of the next 4.5 months, you need to buy one of those identified properties. So let's just use as an example, an apartment complex that's being sold. The buyer removes their contingencies. They have 30 days to close. So now we've got 30 days to start looking and writing offers. And we've already kind of got a head start, right? Because we've already had the client meeting. We kind of understand what we're looking for. So now we're looking around, we're trying to find opportunities. We've got that free 30-day window effectively that begins before our actual 45-day window, right? Now, some other strategies that we generally like to put in place if we can get involved in time is that when the apartment seller is negotiating their purchase and sale agreement with their prospective buyer, we will always advocate for writing in some extensions to close. I don't think I've ever been in a situation where somebody has rejected that idea. Usually it's because they want to buy the apartment complex. And so they're saying, look, if you need an extra 30 days to close or 45 or 60, we're willing to grant you those extensions. So that's a great example of one way you can create some additional time. Let's say that your buyer's gone non-refundable now. They've got 30 days to close. You're 20 days into that. And maybe something happens or you're just not finding the deals that you want. You're getting a little nervous. Hey, we're going to extend. We're going to extend by an additional 30 days. And now you've got that additional 30 days to kind of look around before the ID period comes along. So, that could really create a big window of time to go find properties. And I will tell you that I have never had an exchange get to the point where we've lost the ability to effectuate it because we were not able to find something that made sense. There's always going to be enough volume of properties on the market that will allow us to go find property. And again, I think this all comes back to setting expectations upfront and early with the client, right? So I'm not coming in and I'm not going to say, you can sell your apartment complex, take your proceeds and go buy a 12 cap McDonald's. That's not realistic. And it wouldn't be, fair for me to say that to anybody. Sometimes my advice comes with a dose of reality. Hey, here's the range that you can expect to get. But in most instances, that net versus the apartment net is at least equal, if not better, from my end of the equation. So, and you can factor that into with, future rent increases and things like that would have to take place down the road. So generally, it's a pretty nice breath of fresh air for most buyers to know that we're going to be able to replace the income, maybe do a little bit better. And there's enough product on the market that we're not going to have to sweat it too much.
I want to back up a little bit. And you had mentioned the idea of going and finding a property. And that's another concern. I'm looking at some of these listings. There's a nice KFC over in Russellville, Kentucky. And I know some of my clients are going to say, where is Russellville, Kentucky? And do I have to get on a plane and go look at this property in Russellville, Kentucky? When they're in the midst of a sale, they're getting transaction fatigue already because they're selling their apartment building, which is not easy. And then they got to think about, I think that the idea of having to jump on a plane and rush to a place like Russellville, Kentucky, or St. Joseph, Missouri, or, any of these other places. How often are clients actually going and inspecting these properties before they purchase them?
Well, I would say probably less than 1% of my clients physically get on a plane and go visit this particular property, wherever it is. In today's world, with the advances we have on the internet, Google Earth, and all of those things, they're able to pretty much get comfortable that way. But one of the defining factors of our business is that somebody needs to go see the property. And usually that's me. So I generally will hop on a plane once we've really made a final decision that this is the property we think we're going to purchase based on all of the data that we've received, the lease. So we want to do a lease review. We really want to know that, hey, we're going to buy this property. And at that point, I will usually hump on a plane out to a location to make sure that it is what it is billed as, these guys say it is, right? Because there's no substitute for walking the property, seeing the traffic counts, understanding ingress and egress. What's the topography like? Can you see it from the road? What is the trade area like? Is it dying? Is it improving? Where are the rooftops? So those are all things that, we will try to assess, go out and view and understand. And so, that is another tool in our toolbox that really helps us mitigate risk, right? We're going to go out there and make sure it fits for what we think it should fit for. And we've been successful in the past.
And so if they don't necessarily need to visit the property, that brings up another good point. You mentioned who's reviewing the lease. I know that's a service you obviously offer. I'm sure you've gotten really good at looking at the different types of leases. There are corporate and franchisee leases. I'm sure they're all different. Does a client generally need to bring in their own real estate attorney to review all the due diligence documentation, or do you provide a referral to that service? How does that process generally work?
Yeah, we like to implore the belts and suspenders type of transaction. So, having two sets of eyes review everything to make sure that we all agree that it is what it is. And this is maybe one of the most important things, frankly, that I really try to harp on with my clients. We got into a couple transactions last year where we were told the leases were triple net. We identified the properties. We went down the road and found out after we finally got the lease, hey, they're not triple net. And so that, we had to kind of do some pivoting to make sure we were able to achieve the goal we were trying to achieve there. So getting the lease, reviewing it, understanding it, making sure that it has the elements that, you were trying to find in a property is really important. So I will always advocate for bringing in an attorney. To your point, I have read hundreds of leases and I have negotiated hundreds of purchase and sale agreements. But when it comes to legalese in North Carolina or Florida or Texas, right? Sometimes having an attorney who's experienced in that also review a document makes a lot of sense. And comparatively, the cost for an attorney, my services obviously come from this commission from the seller, right? So comparatively, the cost of an attorney compared to a multi-million-dollar property is just a small price to pay for, some added security.
And then on that note, corporate versus franchise. I mean, talk about the differences in leases. There's a lot of these properties that are out there that typically are a franchisee that owns maybe 20 locations. Do you have any preference when you're guiding a client through the process on whether to go through a corporate, going directly to the corporate or the corporate guarantee versus a franchisee?
I do. And again, I think I've been successful with my clients because we have tried to focus on corporately backed leases. Now, I've sold plenty of investments that have been franchisee backed credit. But I think you have to tread lightly when you do that. So I usually tell people, I'm probably tenant agnostic to a certain degree, right? As long as the fundamentals of the property make sense to me. And again, that's what is the credit of the tenant? How long is the term of the lease? What are the increases in time look like? Where is it located? And if we can solve for most of those things, I don't really care if it's a Jack in the Box or if it's a Chick-fil-A or who it is, but I want to know that my client's money in that asset is safe and secure. They're going to pay their rent on time. There have been a few instances in the past couple of years, I will say in the past 5 or 6 years, where one example is some Wall Street guys came in and they purchased, through like an acquisition, a large portfolio of fast food restaurants. And they went through, recast a bunch of leases that had high rents, put them back out on the market to sell the assets, to make, to try to make a triage of some money, an arbitrage of some money. And, lo and behold, a couple of years later, some of those stores closed, right? And so an investor came in, saw a product that they knew. They had some financial history that, hey, these stores do pretty good, but they levered the rent up too high, which just caused an issue, and they couldn't continue that path forward, right? And so I would rather find a Dairy Queen franchise guy in Texas, who's like, hey, I'm going to open my books for you. I'm going to talk to you. This is a family-run business. We have 25 stores. And you talk to those guys and you get a gut feeling like he's handing it off to his kids and he really believes and loves in what he's doing. But the flip side to that equation is there's people that get into it for different reasons. And I think you just have to kind of weed through those particular issues. Now, if you're buying a Chase Bank or a corporate Chick-fil-A or a McDonald's or a Jack in the Box, you don't have to worry about any of that stuff. You know that if for whatever reason that location does not work, they're still going to pay you your rent on time for the designated period of the lease.
What about location? What about a primary market versus a secondary market versus a tertiary market? I mean, some of the examples I used, St. Joseph, Missouri, and Russellville, Kentucky, I'm assuming that those are tertiary markets versus maybe St. Louis and, would you recommend that a tenant goes into the main markets only, the primaries, or are you okay with some of the smaller markets?
We really try to stick with primary and secondary markets, right? It's not always easy to do that, right? It all depends on specifically what the client's looking for, the type of yield they're chasing. But I've seen too many comparisons where, I was selling a Jack in the Box and just south of downtown Seattle last year. And I had an inquiry from somebody who said, well, it's too expensive. I'm looking at a comparable building in the Midwest at a much higher cap rate. And lo and behold, it was a franchisee run property. The franchisee only had a dozen stores. It was in some little no-name town. And I said, well, you're not comparing apples to apples. We're talking about, a corporately backed 20-year lease in a primary major metro that tax-free, by the way, in the US, that's growing and dynamic, good or bad, I guess. And then, you're comparing it to this property out in the Midwest in the middle of nowhere. And if your tenant leaves there, highly likely that you're never going to be able to find somebody else to pay the rent that you. So that's a really important piece here is understanding what the market is, what's the future availability or viability for that property there, what's the rent that they pay. And that kind of goes hand in hand about where you are. If you're in a primary market, you can probably have a bigger rent. If you're in a secondary or tertiary market, your rent better match the market you're in. So we try to stay primary, secondary.
Understood. Where are you taking your clients these days, Mike, as far as looking for specific types of net lease retail properties?
Sure. Well, we really have been trying to, the fast food or drive-through property during COVID obviously excelled, right? Everybody knows there was a period there where they stayed open, and because of the non or low contact, they were able to provide food. And that really pushed a lot of companies back into wanting to have that drive-through capability. So I'll give you a quick story. Many years ago, there was a term coined fast casual, right? Chipotle wanted to be fast casual. Panera Bread wanted to be fast casual. Well, they didn't want to be associated with the drive-through because drive-throughs, burgers and fries, right? We're healthy. We want to be fast casual. Well, guess who wants drive-throughs now, right? Or a pickup lane if you're Chipotle. So there is a huge value in having that addition to your property. So we still like those properties a lot. Especially, again, the corporate ones. We sold a Taco Bell last year. I sold 5 or 6 Jack in the Box last year, corporate Jack in the Box. We also like service-based industry products. So we've been selling some oil change facilities. And for those who think that the electric car is going, to change the landscape of that, I would probably disagree, because a lot of these companies are pivoting, right? Now what they're doing, instead of just an oil change, they're changing out your windshield washer fluid. They're going to help replace your battery, places they could even register your car. We also like the medical world. So any medical style tenant that's kind of incorporated into retail. So a lot of times you might see a dentist who's out on a pad in front of a shopping center. We love those types of deals. So, but it all goes back for me to the same thing, fundamentals. We want to see who the tenant is, how financially stable are they? How long of a lease is it? Is it really a triple net lease? That's something that we didn't touch on. We touched on in the last video, but it's really important to make sure that you're getting a triple net lease. And if you're not getting that, that's okay, but you need to be compensated for it. So don't pay for a triple net lease if it's really a double net lease. So for me, again, it's sticking to the fundamentals. Last year, we sold some Jiffy Lubes. We sold a bunch of fast food. We sold some sit-down restaurants, things of that nature. And I think that those things, as long as you've got the right protections in place, they're going to be good for a long time.
All right. Well, we've saved the numbers to the last. And as we wrap up here, Mike, where are we at on returns? Because, when folks are coming out of an apartment building, what could they expect to, I'm not going to hold you to this, but in today's market, could they expect to see as far as a return? Equal? Would they take a step back for a couple steps forward? What are you generally setting the proper expectations for on the return on their investment?
Well, return is generally related to risk, right? So the less risk, the lower the return. I will say from 2021 to 2022, now here in I would say early 2022. So let's say 2021, 2022, things kind of went crazy. And then, they've settled down a little bit here in 2023. But as a net lease buyer, I think they're in a better position because I think there's more inventory that's on the market right now. But I think investor sentiment is a little questionable. I think people are trying to figure out exactly what to do with their money. What's the right place to put it? So I think there's inventory on the market. I think properties are sitting on the market a little bit longer than they were originally. I think those properties that we were selling in the low threes, mid threes, high threes cap rate, and the low fours, those are starting to come up into the fours and fives now. And I see this trend kind of continuing forward for a little while. There are a lot of different factors at play that are putting some headwinds in the commercial real estate world. But like I said a minute ago, the COVID era is really pushing a lot of tenants to expand. And so there are a ton of fast food tenants who are rapidly in expansion mode right now, and they want to build, build, build. So that's going to create an opportunity where I think we're going to see more inventory hit the market. Prices are softening a little bit. And so if you're a seller of the apartments today, or, let's say in the next 6 months, I think the future looks pretty bright for you. I am telling most of my clients, that have a couple $1 million up, that we're targeting something with a 5 in front of it, right? It could be 5, 5.5. If you're buying a Chick-fil-A and it's in LA, probably not going to be that. Those cap rates are still hovering around the lower end of the spectrum. But you just have to kind of pick what makes the most sense for you based on your risk tolerance, how long you plan on holding this, and things of that nature, right? So I'm generally shooting for stuff up in the 5s these days, and I think that's pretty achievable.
Now, the 5%, that's coming out of the gate, right? Because you're still not taking into consideration the pro forma of any rent increases over the course of time. Do the majority of the properties that you're underwriting have rent increases built into them?
The properties that I underwrite do, because that's specifically something that we want to look for. Some tenants have become creative in the past few years. And, as the commercial real estate world and as the triple net world has really become more visible through the internet and like you said, websites like Crexi and LoopNet, and people have educated themselves, especially these tenants. They're getting smarter and asking for concessions. And so as a landlord might go to, say, an AutoZone and say, look, we have 3 years left on our lease, we want to renew. AutoZone will say, well, we want something in return too, right? So in order to give you a new 10-year lease, we want that lease to be flat. And so you do see some of those properties out on the market. A lot of the dollar stores are flat leases. The increases don't happen into the options. So that's a question and a discussion that we really kind of have back at the beginning of this whole process when we're setting the expectations, which is, if you could buy something with a long-term lease, know that it's very safe and secure, going to provide you this rent, but it's at this baseline. Is that interesting to you? Or are you only set on having properties that have increases built into them? For me, I think there's enough product on the market that has increases built in over time. And generally that's somewhere between 7.5% to 12% every 5 years. Occasionally you'll find something that has annual increases. Generally those are franchise deals. But I would say for the most part, every 5 years, you're seeing something, 7.5% to 12%. Probably the average across the board is going to be 10%. That's what you're going to see for most deals. And so we advocate, look, as a lease declines in years, the value declines as well, right? But as the rent goes up, you can help that decline of value by having your net income go up as well and offset it that way. And so that's something that we try to advocate for and look for.
Now, are you still looking for at least a 10-year lease when you sign this deal?
Yeah, the conventional wisdom here is that once a lease drops below 10 years, the value really begins to erode because obviously if you're buying a property that has 5 years left on it, there's this idea of will the tenant really renew after 5 years? What happens, right? The risk is higher there. The other piece of the puzzle, or at least there's this idea in the past, is that you get the best financing option on 10-year money, right? The longest term, usually the most accretive financing. And so that has been the common theme that most people think about. For me, it comes down to what is out there and available and comparable If there was a property that we thought had a covered land play, meaning, the land was so valuable, maybe the rent was under market, there was some reason that we wanted to go in and buy something that had less than 10 years, maybe there's some upside down the road, then yeah, I would advocate for that. But again, it comes on a case-by-case basis. I will say most of the properties that we have purchased for clients in the past couple of years have had at least a 10-year lease, if not 15 or 20.
What are you generally seeing with a owner that's coming out of an apartment building when you're starting to compare their cash flow? What do you typically see? I know a lot of owners think they're going to take a big step back. Is that really the case?
It hasn't been, if I'm being honest. I think what a lot of apartment owners think about when they think about comparing income levels is they think about comparing their gross rents with the net rent of a single tenant triple net investment, right? But the reality is there's obviously a lot of expenses that go along with running an apartment complex, right? So you've got property management, taxes, insurance, and then all the maintenance that goes along with it. So it's different every year. And in most instances, I haven't met a lot of apartment owners who really know what that final number is because it changes and shifts. But I would say we are at least able to replace it. But in most instances, we can generally get somewhere between 10, maybe 15 or 20% more because now they're not having to pay for all these other taxes, insurance, maintenance, right? And those can fluctuate, right? Maybe the maintenance one year is higher than it was the previous year, things of that nature. When you buy this, 20-year lease to Jack in the Box, you do nothing. You don't even need to go see it. They're just going to put the money in your bank account, every month and you're happy. You go travel the world or sail or play tennis or bridge or whatever you want to do.
Do some of that deep sea fishing for that tuna out there off the coast of San Diego?
Right there. That's right.
Awesome. Well, Mike, I'm glad we got to do this again. Any last minute comments for the potential client who's considering selling some sort of highly appreciated asset and rolling that asset or equity into a net lease property?
Yeah. I mean, what I try to help my clients do is educate themselves first and foremost, right? And so a lot of clients, as you know, Doug, probably haven't sold or entered into purchase property in a number of years. And so I say, look, go meet with a professional, understand, the process. It's changed over the past 20, 30 years, right? Probably when a lot of these folks bought a property last. Understand the process, debunk the myths, get comfortable with it. And it's not as scary as it seems, right? And if you've got a seasoned professional in your corner, you're going to be successful. And the feedback that I get from my clients post close, which is usually, "Hey, we want to sell the other one now because this thing is just too easy," and our thought about keeping one just for some additional risk tolerances, it's changed. So that's that would be my last advice. Just, go educate yourselves, find somebody, ask questions, get comfortable. And I think that'll help everybody along the way.
Perfect. Well, there you have it. If you are considering getting away from the terrible T's, the tenants, toilets, trash, termites, and telephone calls, and you want to go into something that gives you a little more time and tranquility, a triple net opportunity certainly would be a great way to go. And reaching out to a trained expert like my good friend Mike Campbell here of the NNN Investment Company would be a good start. So we're going to put Mike's information in the description on this video. You could also reach out to me, dougtabor.com, and I'll get you his contact information. And if you are looking for some more information on net lease properties, definitely reach out to us. Michael Campbell, my good friend, thank you so much, sir. Let's not wait another 2 years. Maybe we'll have to do a couple more of these before the end of the year. How does that sound?
I would love it, man. That'd be great. Always enjoy the time.
All right, man. Thanks for being on, Mike.
Thank you.